If I'm 62 years old, but I'm in good health, am I too old to get a whole life insurance policy? The answer is no, if your goal is cash value. I'll give you an example. So a lot of times we get this question, and where I like to start is if you are just price quoting a whole life insurance policy, if you're 62 years old, it's going to be expensive. However, if your goal is cash value, you're not too old by any means. The reason why is because we can set up a policy the exact same way for someone who is 62 compared to someone who is 32 years old. So let's look at this example. We're going to assume we have two individuals. One is 62, one's 32. They're both in good health. Their goal is to fund $20,000 per year for 5 years, which is a total of $100,000 going into a whole life insurance policy. And the goal is to get as much cash value as possible. Now, here is the key on this. The policies will be designed identical. They'll be the same insurance company, same product, same out-of-pocket, and here's the key. The minimum premium will be about $2,000 per year. They'll each have $18,000 per year going into the PUA rider. The premium, by the way, includes the base premium plus the cost of the term insurance rider. That term is important to prevent a MEC from occurring, which leads me into the death benefit. This is where you'll see the difference. The death benefit is going to be at the absolute minimum for both of them. However, it'll be at the minimum dollar amount to prevent a MEC. And what you'll find is the older someone is, the less life insurance they need to get the same MEC limit. So the younger individual will need more life insurance benefit to get the same $20,000 MEC limit compared to the 62-year-old. So let's take a look, and we'll start with the 32-year-old. What we've got is him paying $20,000 per year, and the priority here is to get as much cash value as possible. So year one, you see 20 grand going in. First year cash value, $17,655. The initial death benefit is $500,000. So he funds it for 5 years. By the 5th year, he's funded a total of $100,000 and he has $105 in cash value. You'll notice after the 7th year, because he does not want to put anything else into the policy, we reduced the death benefit, as that's the earliest we can reduce the death benefit without triggering a MEC, which is a taxable event, but that helps lower costs and allows the cash value to grow at a faster pace. So this is for the 32-year-old. Let's look at the same scenario, but for the 62-year-old, because he had this question, am I too old? Here we go. So he's putting the same 20K in, and I designed these policies identical. Exact same product with the exact same insurance company. This is a Guardian illustration. So when you're older, the cost is slightly higher, but do you notice a big difference in the first year? No, you're at $17,345, which when we look at the difference in cash value, the first year is not all that much, is it? No, what is it? $310 in favor of the 32-year-old. But there's not a drastic difference, or I should say, at least not as drastic as many people often expect. If we look at the 5th year, he's put away a total of 100. His cash value is almost 103. So that is less than the 32-year-old who had 105. But when we look at the difference, it's about $2,300 over 5 years. Now the big difference would be the life insurance benefit. Day one, the 62-year-old has $230,000 of life insurance compared to the $500,000 life insurance benefit the 32-year-old has. The reason why is because when we look at these policies, for the 32-year-old, 500K got him a $20,000 MEC limit, where 230K got that 62-year-old, guess what? A $20,000 MEC limit. The death benefit has a direct relationship to the MEC limit, death benefit and our age, that is. Now, as we look at the cash value difference column, what do you notice here? The gap widens. And if we look at year 25, it's about $50,000, and he paid in $100,000. So you could argue that that is a big difference, but that's also over 25 years. What I would say in a case like this is, well, that comes out to a little bit more than $2,000 per year in favor of the younger individual, because when you are younger, the internal costs are less. However, I don't think it's drastic as long as everything is designed in favor of prioritizing the cash value. Anyway, I would answer that question with a no. You are not too old by any means at the age of 62 to start a whole life insurance policy. The key is really just making sure that the product is designed with a minimum insurance expense and to have as much cash value as possible. I hope this video was helpful. See you in the next one.